Welcome to the Knock Knock Property Podcast, presented by local property experts Ben Dilling
and me, Matt Dixon.
Coming to you from Fox's Sales and Lettings. We'll be discussing all things property related, including some local guests from the local area. Anything else you want to add, Matt?
Not really.
Not really, just like and subscribe.
Well, don't. We'll be doing it either way.
We'll do it, yeah. But, you know, if they do like it, just tell your mates. Thanks for listening. Should we get on with it?
Go on then.
Okay, so welcome to episode 2 of the Knock Knock Property Podcast. And on today's episode, we welcome our first guest, Matthew Fleming-Duffy from Knight Frank Finance. Matthew has been helping homeowners with their property finances since the early 90s. He's a highly regarded mortgage advisor and later life lending specialist, as well as an advocate for green mortgages. So in this episode, we get to talk about all of that. We also discuss Matthew selling a business and his journey to Knight Frank. As always, we hope you enjoy this episode, and if you get the chance to like, subscribe, follow where you can, we really appreciate it. Enjoy the episode. So, Matthew, welcome.
Thank you.
Thank you for coming.
Thanks for inviting me.
Our first guest on the Knock Knock Property Podcast. What did you make of the first one? Bit of fun, bit of an introduction. You can be honest, it's fine.
Yeah, no, it felt good fun.
Yeah.
Felt like something I'd like to be taking part in.
Yeah, indeed.
So no, yeah, good stuff. Very informal, very...
Yeah, we don't want to be... Well, me and Matt, who's in the background here, we just want to be a little bit more relaxed, but obviously when a guest comes on, there'll be a bit more meat on the bone. So,
right. So I'm the meat.
You're the meat.
Right, you're the bone.
That makes me the bone then, doesn't it? Yeah, good. So, thank you for coming on. Obviously,
Pleasure.
we go back. We were just trying to work out. I think it is about 20 years. Your lovely wife, Liz, I think sold a property through me in Branksome Park.
Correct.
And we spent many an evening in Cameron's in West Discussing it,
yes.
yeah. Probably consuming some alcohol along the way.
Yes.
Maybe. We've grown up now, though, haven't we?
Yeah, we don't do that anymore.
No, we don't. No,
That's
absolutely
coffee
not.
and croissants.
Hey, coffee and croissants. Did you enjoy your croissants?
I did, yes.
Good.
And thank you for selling another one of my properties more recently.
Yes, I have. Yeah. So we have actually just sold your place
One
in
of my
Ferndale.
properties. Thank you
And
very much.
it went through rather successfully, didn't
Well
it?
done. Good stuff.
Happy days.
Top work.
So you are what I would consider a property finance guru. Would you say that's accurate?
The guru.
Guru.
Yeah, I don't know. I can go with that. I've been in the mortgage market, worked in financial services now for best part of 30 years.
Yeah.
So I've been involved in all different aspects of mortgage lending.
Yeah.
There's not much I don't know about the mortgage market. Having said that, of course, the mortgage market is constantly changing.
Yeah.
Products and criteria evolve on a regular basis. So if anyone could be classed as a guru, I think it would be more the tech providers these days, because they are the sort of fount of knowledge.
Right.
I've been around for a long time.
Yeah. Well, I mean, I know we've worked together sporadically from time to time, and it's always been pretty successful. But So talk me through your background and how you have come to work at Knight Frank Finance.
How far back do you want to go?
As far back as you want to go, mate.
My life story.
Yeah.
To be fair, I'm a failed pilot.
Are you?
Yes.
I did not know that.
I spent many years when I was younger flying aircraft, aerobatics, all this kind of stuff, and took the entrance exam with the RAF to fly fast aircraft, and I failed.
No way.
They offered me the role as a navigator,
Right.
And I said, nope, I want to be a pilot, and I'll come back in a year, because you need to stay away for a year before you reapply. And in that year, I went off and I guess I wandered around. I did a lot of different things. Over a period of time, I moved to the States. I sold rock crushers in Chicago.
Right. So you lived in America as well?
Lived in America.
So this was all before we met?
Yeah.
Okay.
And I worked for my uncle's carpentry business in the Middle East.
Nice.
And my mum said, go and get a job, get a proper job, get a job at a bank, job for life. I went to work for Abbey National or Santander. as they're now known. Worked for them for quite a few years. Went independent, so set up my own brokerage after a period of time, and I've been independent now for, I guess, 16, 17 years.
Okay.
My business, Cherry, I sold last year.
Yeah. You like that name, didn't you, Matt?
I do. I like it.
He's a Cherries fan. Was it something to do with
that?
Yeah, we questioned that, didn't we? Yeah, and I said no, it would never be.
Well, I sponsored one of the urinals in the
Class.
that's where you see. Yeah, so we sponsored one of the urinals. So that was all we could afford at the time.
Yeah.
I sold the business. Met up with the guys at Knight Frank Finance. And now, I work for them as a mortgage broker.
Yeah.
With a specialism in later life finance.
Indeed.
So,
yeah. So that's right. So you're Knight Frank up in the big smoke then, I suppose. Is that where they're? But do you work from home or do you work from London or a bit of both?
Yeah. So Knight Frank's a large company. They've got, I think, it's something like 20,000 employees worldwide.
Yeah, because obviously I heard of them predominantly through estate agency, high-end estate agency mainly, I think.
Yeah, so they're a property company. They do all things property related. Surveying.
Yeah.
The estate agency is the most well-known part of it, certainly in the UK. They're a London-centric estate agency, but have offices all around the UK, as far north as Edinburgh now. And I work for the finance team. So Knight Frank Finance sits within the group of Knight Frank. The main office is in Baker Street in London.
Yeah.
I tend to work out of there a few days a week. We have a satellite finance office in Guildford.
Okay.
But I tend then to work from home. I think a lot of people do these days, hybrid working,
absolutely,
being what it is. A lot of people work from home outside of their normal office working days. So I split my time.
And how long have you been with Knight Frank?
Only 6 months.
Okay.
It's been a great experience so far.
Yeah.
Great bunch of people.
Because I know obviously you've moved on to some extent to later life lending, but you still do mortgages for people. You still cover the whole spectrum, as it were, or
So as a mortgage broker, any broker can deal with home movers, remortgages, first time buyers.
Because you have got a lot of letters after your name, by the way.
I have.
What do they all mean?
So I'm FCMI, which is Fellow of the Chartered Management Institute.
Right.
I am CMAP, which is a Certificate in Mortgage Advice and Practice.
Right.
I am CFA, which is a Certificate in Financial Advice.
Yeah.
And CRUR.
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 Yeah. Is that the rural one?
That's the Equity Release. So that's certificate in certificate in Regulated Equity Release, I believe. But so that's the later life finance paper.
Okay, so we'll come on to the later life lending in a bit. But in general, how are you finding the market? Because obviously you're speaking to all the people at Knight Frank Finance. You're probably integrating with the other members of other departments there. What is the general feeling in the marketplace at the moment as we're now sort of coming towards spring?
Positivity, I think, is the underlying sentiment. Don't underestimate the resilience of the property market in the UK. In terms of the mortgage market, things have changed.
Yeah,
the rate environment, of course. It's headline news. Rates have certainly changed and moved up. They moved a bit too high, pretty much in a response to the
wonderful Liz Truss.
Wonderful, the misplaced mini budget. It sent markets into a spiral.
Some lenders stopped lending for a time, didn't they?
Yeah, particularly those that were reliant on funders. So in terms of the way the money markets work, prices went up. Access to funds diminished. So some lenders stopped products or certain product lines. Certainly rates really jumped quite high.
So what sort of fixed rates, what were the rates before Liz Truss did her magic moment? Poor Liz.
Poor Liz.
I know.
Yeah.
What were the rates looking like then, and what did they go to? And I'm right in thinking they might have crept back a little bit.
Yeah. So rates you could have got around 1% with a decent deposit for standard transaction. The discussion on rates is always quite tricky because we talk about averages, we talk about best rates, but to be practical about this just for a minute, there are over 150 lenders in the UK, something close to 200 lenders in the UK.
Right.
The mortgage market, the finance market is so broad and diverse. There are literally thousands of products, and it's not easy to kind of simplify it to a certain extent. But yeah, in terms of the best rates, we were seeing, quite a few lenders offering products around the 1% mark as a very competitively priced, variable or fixed rate deal. Rates jumped in as a direct reaction of the mini budget. More to do with the fear of where things could end up, and rates jumped really quite high. So we saw all rates really above the kind of certainly 4.5-5% mark.
Yeah.
Those rates now have, on the whole, reduced. Even though the Bank of England, of course, is pushing up the central banking rate, it's money markets that banks go to secure funds.
Yeah.
So the kind of the diminished fear aspect, I think, is really having an effect then on the access to funds.
Yeah.
So funders become more competitive. The gilt rates have reduced as well, which is
what's the gilt rate? What's that mean?
Gilts. So if you invest money in a savings account, you would you'd come across a bond. And a bond would be where you lock your money away for a period of time, a year, 5 years, 10 years, and you get a guaranteed rate of return.
Right.
That's a bond. If a government issues that type of bond, it's called a gilt in the UK. So this is the government saying, invest money with us, and this is the rate of return that you'll get. So money markets have one eye on what they can get as a safe and guaranteed rate of return compared to providing money to lenders. Right. So if they put money out to lenders then, put that money out to us as consumers. So that's the money market. Okay. That's essentially how the money market works. We can talk about swap rates as well, which is where banks lend, institutions lend to each other. But yeah, so these rates, even though the central rate has increased, the gilt rate has reduced. So banks don't tend to go to the Bank of England for loans. Famously, Northern Rock did it quite a few years ago.
2008.
That's right. And
October, I think it was.
Remember what were you doing at that time?
Yeah. Crying.
Yeah. Well, we all. But of course, if that was headline news.
Yeah.
I guess it's fair in some ways to describe the Bank of England as a lender of last resort.
Yeah.
So funders would tend to put money into gilts or into markets, and the mortgage market is a big part of that.
Yeah, because I think what frustrates me when we my simplified view on it, and the frustration in the media to some extent, they will talk about that's the headline news, interest rates going up, but I'm telling my customers that and clients that actually the mortgage rates were actually and have been coming down, but that's not that doesn't read well for a news article, does it? No. Unless you know the right places to pick up on the news and that kind of thing.
Here.
But the average Joe, absolutely. Yeah. The average Joe blogs will probably think, interest rates going up means doom and gloom. But
I mean, you're exactly right. Knight Frank Finance website, knightfrankfinance.co.uk has a great news section. You can go to that news section and get some real insights into the mortgage market and some honest indicators as to what's happening with rates and the market in general. And the question you asked originally was, what have rates done? So Platform Home Loans recently launched a 5-year fixed rate at 3.75%, which is what I explained about the Bank of England gilt rates and swap rates, and the markets do something different a lot of the time when compared to the Bank of England central rate. So that rate that we would, borrow at as consumers is lower than the Bank of England base rate, and it's fixed for 5 years. So it gives you an indicator as to what the markets expect to happen in the longer term. Now, the problem with this, of course, is that these lenders have limited funds. That product with platform was available for 48 hours, I think.
I read that this morning. Yeah.
HSBC have just launched a rate at 3.89%,
right,
for over 5 or 10 years. Let's see how long that hangs around. Yeah. So on the whole, the mortgage market rates start at around 4.5%
on average, 4 to 4.5.
Yeah, and there's a lot of lenders, mainly building societies. A lot of the time, smaller building societies offer variable rates at that kind of level. I think the Newbury Building Society have got a rate at 3.79, which is variable. That's still around, but of course, variable means it could change.
Yeah, sure, and that will change in line with
their variable rate.
Yeah.
So you get a discount off the lender's variable rate. Again, so to talk in more broad terms, as consumers, we do not borrow from the Bank of England. High street banks don't tend to borrow from the Bank of England. It's a good indicator as to what's happening around the market. And of course, if you have a base rate tracker, people would have a base rate tracker, then they would have a rate that's directly tied to the Bank of England base rate. That's right. But we don't borrow from the Bank of England. We borrow from lenders, so banks and building societies. So those rates are constantly changing. Loads and loads of products.
Sorry to simplify it down even more for me. So a tracker would directly be affected by the interest rate rises.
Yeah.
Okay. A variable rate that could vary during the term of that mortgage, depending on the interest rate, or
so if you rewind, you go right back to the history books, where you need to start with this a little bit. When you go into a bank to borrow, so you're borrowing from bank or building society, you borrow at the rate that they set. That rate is generally going to be higher than the Bank of England base rate.
Yeah.
So again, if you look at the market at the moment, most lenders have got their variable rates, their underlying variable rate at anywhere between 6, 7, 8%.
So a variable rate is going to be more than a fixed rate.
Variable, that's the lender's their own variable rate. So when you see a discounted variable rate, that lender is offering you a discount off of their variable rate. So that's the Newbury deal, 3.79%. I need to check what their variable rate is at the moment, but that you're getting a discount. So that can change as they change their rate.
Okay.
So Bank of England changes, they meet first Thursday of every month and decide what they're going to do to central banking rates. Building societies, banks will move their rate as and when they see fit. Now, that tends to be in line with the Bank of England. So if Bank of England moves up by a quarter, you tend to see most mortgage providers also move their rates up by a quarter, but not always. They can keep those rates where they are, or as we frequently see, some would pull their rate down so they can grab a headline.
Yeah.
Actually, this is what the Bank of England's done. This is what we've done. Come to us. So it's again, I go back to this other sort of point of how broad and diverse the mortgage market is. There are literally thousands of products, and they change on a daily basis.
Yeah. I think that's what the average consumer on the high street struggles with. They see interest rates going up, and they just think that means mortgage rates are going up. But there's more to it than that, isn't there? Let's be honest. And a fixed rate. So how long would you fix a mortgage for? What are the terms for fixing a mortgage? Just to somebody that is completely new to the process of getting a mortgage.
Yeah. So in terms of the mortgage market, you'll find lots of deals around 2, 5, and 10 years.
Yeah.
You'd also find fixed rates over 3 and 7 years.
And the longer that term, the worse the rate would be?
Not necessarily.
Okay.
Not necessarily. And just to sort of touch on this as well, with later life lending, a lot of borrowing is on a lifetime fix. So what you borrow at now is the rate is fixed for
forever.
The term of, until you pass away.
Okay.
Or as in the property is sold, So 2, 5, and 10 years is where you'll have bulk of options. And then as a consumer, when you start looking at what should I be doing, it does come down to your personal circumstances, because it's very difficult to predict what's going to happen to rate markets. It's very difficult to, compare these products until you've come to the end of a term. 5-year fixed rates have become a lot more popular in recent years, I'd say, just because of a lack of stability. Very, very low interest rates, which makes longer term fixing quite attractive, but also, with the increased volatility that we've seen in the last couple of years, certainly following the pandemic, more people have wanted to tie in for longer. So 5-year fixed rates have become.
And the length of term of these mortgages, on an average mortgage, we sort of look at 25 years, 30 years. I see them going longer and longer now.
So of course, with the lifetime mortgage, it goes on.
A lifetime mortgage goes on
until
you pass away or the house is sold. Right?
Yeah. So 40 years is the longest term that you'll see. 35 years is a lot more common. 25 years, again, is just something out of the history books, where lenders started providing mortgages. They set a term at 25 years, and it became the norm. Everyone then sort of set their budgets based on a 25-year mortgage, and it's still to this day pretty much the kind of the go-to term.
The benchmark.
If I sit and talk to somebody, the start point is kind of 25 years, unless you're near retirement or you've got different reasons, or indeed a 35 or 40-year term helps you with the affordability assessment.
Yeah, so it's stretching it over a longer term, brings the payments down.
Correct.
Yeah,
correct.
So because obviously speaking to a lot of people, explaining that you were coming on and mates at the golf club and stuff like that. Some of the young guys up there wanting to get on the property ladder. How hard is it to get a mortgage now? What sort of deposit do you need? Because I remember before 2008, you could get a mortgage and the bank would give you some money on top, 120, 10% or something ridiculous. Yeah. And in fact, when I got my first mortgage, it was a good old fashioned self-cert mortgage. Yeah. And I think I just the guy said, what do you want to be earning to get this mortgage? Yeah. Obviously regulations changed an awful lot now. Yeah. But 100% mortgages were quite normal. What are we looking at now, deposit wise, to get a decent rate?
So the minimum you need is 5%.
Yeah.
And if you have a 5% deposit, you can go to the Nationwide and get a 5-year fixed rate at around 5%.
Okay, that's pretty good.
It's not that bad.
No.
The other sort of question you just asked is how tricky is it to get a mortgage?
Yeah.
And look, following the credit crunch, mortgage lenders have come under lots of very strict regulations. The Mortgage Market Review was a set of UK regulations, came into force in 2014. The Mortgage Credit Directive was another set of regulations, EU regulations that came into force in 2016. We're still pretty much complying with those rules. All of these were about protecting consumers, trying to stop the market imploding again. And a big part of that was pre-credit crunch, banks just weren't asking questions. You mentioned self-cert, not checking somebody's income and expenditure before you give them a mortgage was going to have obvious consequences. Absolutely. And it did. Yeah. So following that credit crunch, following these rule changes, I should say, self-cert loans have been outlawed essentially, but lenders have since then gone through very detailed affordability assessments. So they look at your income.
Because I know I've looked at applying for mortgages in recent years, it's in depth now, isn't it?
Yeah.
In terms of they'll look at every single,
absolutely,
your inside leg measurements and how expensive were those trousers to fit.
Yeah, how much do each take?
Yeah, absolutely.
Yeah.
So because again, a mate at the golf club, very kind of like naive to the whole situation. He was like, "Oh yeah, I'm trying to save, but I'm taking out some money out of my bank cash every week." And I said, "Well, what's that for?" He didn't want to tell me what it was for, and I was like, "He goes, does that come into effect? And does that?" I said, "I think everything's taken into account now in terms of but breaking it down to gymnasiums, mobile phones, weekly shopping, child allowance and all that sort of stuff.
Yeah, so lenders are going to certainly look at your income. Your income is based on your taxable income.
Because just quickly, back in the old days, right?
Yeah.
Didn't it used to be like 3 or 4 times your salary, and that was always?
It was really easy. I mean, I was at Abbey National. I was a financial advisor and underwriter, and when you needed to run an affordability calculation, you picked up your calculator, punched somebody's salary, times 3.75.
That's right.
Equals. And that's how much you can borrow.
Look at house prices now.
Yeah,
and
it's different. The Bank of England issued some guidance a few years ago that lenders shouldn't be lending more than 15% of new loans at more than 4.5 times salary.
Okay.
That kind of tripped out into the market as 4.5 times is a kind of cap.
Yeah.
When
was that?
In reality, so it was a few years ago. I can't remember exactly when it was. They softened their stance on that more recently. However, if you get back to this idea of an assessment of your income and expenditure, yes, mortgage lenders will look at your income, your taxable income. So if you're self-employed, they look at salary, dividend, net profit, things like that. If you're employed, they'll look at your basic salary plus bonuses, commission, overtime, things like that. All of that is your taxable income. They use that to see how much money is coming in to your bank. They'll validate that by also checking your bank statements. They'll then look at your bank statements to see what your cost of living looks like. There will be fixed expenses like council tax, utility bills, insurances that can't be changed. They will look at certainly spending habits to a certain extent, but not all lenders do that. Some lenders would just take an average. So we think that as a family of 4, your living costs are probably around X. We'll check your bank statements. So a couple of other things that lenders will look at will be your debt, your existing debt.
Yeah.
So personal loans, credit cards, car loans, overdrafts to a certain extent. Yeah. All again, if you have those committed monthly payments on loans, they are factored in and will reduce an amount you can borrow on a mortgage.
So just to interrupt that, then let's just work on figures of, say, a house of 300,000, okay, and a 10% deposit to get a reasonably good rate would be £30,000. Managed to work that out. And you've got 30 grand deposit, 10 grand on a few credit cards, and you've got a car loan and an overdraft, all of that. So let's say your debt is in the region of £10,000, but you've got £30,000 as a cash deposit towards a house. That would that £10,000 debt immediately come off that £30,000 deposit?
No.
Okay.
No. So affordability calculations are a lot more complex.
Yeah.
Rightly so. I mean, a mortgage debt is likely to be the largest debt you're ever going to have in your life, and for most people in the UK, homeowners, that's the biggest investment we'll make in a lifetime. So lenders will look at your income and expenditure. The expenditure would factor in the debt that you have, and off the back of lots of maths that goes on, via computer, a magic number appears on lenders' affordability calculators that shows how much they consider lending to you. Again, if you remember, we sort of have to factor in the length of term. So if you're younger, you can stretch that term beyond 25 years to 30, 35, even 40 years. If you are older, then of course the term is going to be limited to the point that you're seeking to retire. So the affordability calculations overall are quite tricky, and it's become one of the trickier parts of working as an intermediary, certainly post credit crunch and post the rule changes.
Yeah.
So the old calculator 3 times equals
it don't cover
just
anymore.
Doesn't work. No, it is. I guess within reason, this is partly why so much business now goes through intermediaries. I think it's something like 80% of all mortgage lending these days goes through intermediaries. So if you do have that question, how much can I borrow? You really are best going to a broker. I will sit and run, some figures based on, any sort of standard scenario. And there are tools that we can use that go to a whole bunch of lenders instantly to find out how much somebody can borrow. And the range is phenomenal. It really is phenomenal. It incorporates high street banks with some specialist lenders, within that. But the range of how much somebody can borrow is quite fantastic. Right. And it changes. So lenders don't have this fixed idea of what they're going to lend you. It can change. It can change with your location. So the cost of living is higher down in the south.
Really? So depending on where you are in...
Yeah.
Wow, okay.
Yeah, postcode can have an impact. How many children you have, that has an impact, obviously. So there's lots of things that lenders used to factor in when running affordability checks. And like I say, it's one of the bigger parts of the journey now when trying to work out who to go to, which lender is the best lender for you.
What I wanted to ask you, just regarding mortgages, so Help to Buy was a massive thing, particularly for new builds. And now that scheme has pretty much come to an end, right?
So Help to Buy won. Yeah. The initial scheme set up by George Osborne indeed helped builders feel confident in their ability to build property on the basis that this is, again, the post-credit crunch era, that when they build a property that somebody could come along and buy it. The government gave you a loan at a zero interest rate initially and a very small rate after a few years to pay a big chunk of deposit, 20% deposit towards a new build property. That was known as the Help to Buy scheme when it first launched. A lot of people after that scheme had been around for a while said, I don't want to buy a new build. I want to just buy from the open market. So George Osborne created Help to Buy 2, which was a mortgage guarantee scheme. So you could borrow up to 95% of a property value. Banks were not comfortable lending to that value at that point. So the government underwrote, 15%? Gave a guarantee, I think it was 15 or even 20% guarantee that they provided to the bank. So the bank then felt confident to lend to you at 95% of a property value. Help to Buy then was seen as being so successful that the other government schemes like Right to Buy, which is where if you've been in a council property for a number of years, you can buy it at a discount. Shared ownership, where you buy a share of a property and rent a share through a housing association. The Forces Help to Buy scheme. So
we've just done one of those actually. We've had a client buy through that. Has that come to an end as well?
No. So the Forces scheme is quite literally
you've done quite a lot with the Forces, right?
Help to Buy generally. Yeah. I mean, like I say, the scheme itself isn't no longer, the original scheme is no longer around. Neither of the original Help to Buy 1, Help to Buy 2 schemes are around. So Help to Buy almost is a generic term for government incentives to help you buy a property. And certainly the new build equity loan and the mortgage guarantee scheme have gone. The other schemes stay in place. There is something that has loosely replaced the Help to Buy 2, the mortgage and the mortgage guarantee. It's called Deposit Unlock.
Okay.
And
I've not heard of that yet.
Deposit Unlock. I'm yet to see it have an impact on the market. Essentially, this is where lenders will provide you with a 95% mortgage and take out an insurance to guarantee themselves if you don't pay the mortgage, property values drop and they have to repossess. And if there's a shortfall, that the insurance would pay that shortfall. That's mortgage indemnity guarantee. Yeah. That was around for decades until I think around the late 1990s.
Indemnity, yeah.
Mortgage indemnity.
My parents had one.
And banks decided they didn't want to pay insurers.
Yeah.
They then just started charging a fee, a high loan to value fee, so they became more profitable. And then they had no insurance. So banks became more profitable but weren't insured. And of course, credit crunch came along and disrupted all of that.
Yeah.
So this is almost just a step back to where things were in the 1990s with high loan to value lending. But like I say, the actual scheme itself is yet to have an impact as far as I can see it, because there are enough mortgage options around at 95% if that's what you need. It's new build property, so it's 95% on new build property, and they have a deposit unlock scheme. The interest rate on it, interestingly, is higher than it is for buying from the open market. So it's a product. It's out there. It hasn't really replaced the Help to Buy scheme, but yeah, I mean, like I say, the scheme itself is now just a common term for government assistance. So I think various schemes will come and go in years to come.
You are an advocate for green mortgages. What's a green mortgage?
Green mortgage. If I take it just a step back from that for a moment, because green mortgages are quite a small part of a marketplace, which is more focused on what's commonly referred to as retrofit.
Right.
So in simple terms, if you own a property and you have a low EPC rating, energy performance certificate rating. In other words, your home is not efficient with energy. It's not very insulated. You've got an old boiler. You'll have a low EPC rating. If you wanted to make your home more energy efficient, you would either use your own cash or you would borrow. You may borrow short-term personal loans, credit cards to fund small, green home improvements, if I can call them that. If the funding was more substantial, or if it just makes it easier for you, you might consider using your mortgage lender to provide you with a home improvement loan. So that lending is technically classed as green lending. You're borrowing money to make your home more energy efficient.
So it's not just on a new build energy efficient home.
So we then get into this realm of the green mortgage market.
Right.
The originators of green mortgages would, I think, be the Ecology Building Society. They will help you do exactly as I just said. Buy a property that's run down, needs a bit of work, and needs to be made more energy efficient. And as you improve the energy efficiency of your property and your EPC rating improves, the discount that the Ecology would apply gets better.
Right. Okay.
So that, to me, is the way a green mortgage should be described. There is another part to the green mortgage market which is more common at the moment, and this is what you're referring to. And this is where some lenders, particularly the high street banks, have just gone for providing you with a marginal incentive if you buy a property that's already A or B rated, A, B, or C in some cases. So the green mortgage market almost has two guises. Either you're being incentivized to buy a property that's efficient, or, and it's a much smaller part of the market, you're looking to buy a property or you own a property that you're trying to make more energy efficient, and you'll get discounts to do that.
And when you say incentivize, what does that look like? What does an incentive look like?
It can range from small cashback. I'm going to say small now because the incentives aren't great at the moment. This is going to change. But at the moment, you'll find cashbacks of sort of £500 to £1,000.
Just money given to you.
Yeah.
Right.
Yeah.
Okay.
Or, kind of a 0.1% discount off of, the other sort of conventional mortgage products.
Right. Okay.
So green finance on the whole refers to this energy efficiency. And, retrofit is the way we describe taking a property and conducting green home improvements.
And the eligibility for that, is it the same criteria as getting any mortgage? So,
Yeah. So like I say, because
surely they've got to encourage this to make us more energy efficient, right?
Yeah. So if I put this into context, if you came to me and said, Matt, I've got a property, I'm worried about my utility bills. I know I can put solar panels on my roof. I can put a new front door on, get triple glazing, blah, 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 and I need £15,000 to do that. I would say to you, when's your mortgage up for renewal? So, you may reply July this year. I would say go and get quotes. You've got your quotes, it's £15,000. When your mortgage comes up for renewal, we're not just remortgaging you for your £100,000, whatever the balance is, existing mortgage. We'll increase your borrowing to £115,000, so you've got cash to go and conduct those improvements. Now, when you then speak to me, as an FCA regulated mortgage broker, I'm obliged to, and rightly so, I'm obliged to find you the best deal. So that may just be a standard high street bank that has the best current deal at the moment. So we could call that a green mortgage if we wanted to.
Right, I see.
However, it may be that the product is one of these retrofit type products where you get an incentive once you've completed the works and your EPC rating's improved. But those products are so much in the minority at the moment. The government, the Government Department of Business, Energy and Industrial Strategy, or BEIS, have recently launched a scheme competition for providers of green finance and the wider market of green finance. The Green Home Finance Accelerator Program is the name of the incentive. They're offering funds to retrofit installers, to local authorities, to banks, to fintech providers, to tech providers, to create a mechanism to encourage people to make their homes more energy efficient.
Because, of course, we're seeing it in the lettings market that soon your property is going to have a minimum rating. I mean, there already is a minimum rating, but I think that's coming up even further and it's going to become stricter.
2025, for new lettings, you'll need to have a C-rated property.
Rating or above,
And for existing lettings, existing tenancies, it's 2028. So you've got to make those improvements.
Absolutely. I know we're looking at that now. But it's interesting because I remember when EPCs came out, and I suppose, average rating when the EPCs came out for the average home in the UK was actually a low D, I think, at one point. Now that's, if we're looking to get rental properties up to a C, and you know what some landlords are like, they can not put too much time and effort into their properties. It's quite a change, actually. So
it is, and
a good one, I think.
It's a good one because we've got to talk about energy price security, haven't we? Our bills have gone, everyone's bills have gone flying through the roof. It becomes one of the biggest expenses we have, particularly because of what's happening in Ukraine at the moment. So it's a big problem, and it's not going away. So the only way you can remove your exposure to those fluctuations in energy prices is to rely less
on it. Become more energy efficient.
And there are 3 pillars to making your home more energy efficient. That would be to reduce your demand on energy. So insulation, so triple glazing, new front door, things like that. Second pillar would be to look at generating energy at home. So solar panels are the most common, but ground source, air source heat pumps, wind turbines maybe. And the third pillar is the technology, so smart meters, even EV charging points for people that are embracing the EV car revolution. So it's a lot broader than just those that want to reduce their CO2 footprint, which for a lot of people is very important. But for the majority of homeowners, it's their monthly budget that's the most important. So reducing your demand for energy is very important. And there are lots of measures you can undertake these days to do that. And for most people, you need to borrow, and hence the green finance market.
So we've got a house, I mentioned it to you when we just had a little break, which was built by Bellway Homes near the Angel Pub in Longham. And so that house is only about 3 or 4 years old. And that has a rating of B. And I actually put in the details, energy efficient home, because obviously it's big news, more so now than ever. So if I'm showing somebody that particular house, I could have a conversation with them about getting a green mortgage.
Yes, I mean it's becoming a big selling point. There's lots of data now. Santander, Rightmove Knight Frank have also released some data around how much more somebody will pay for an energy efficient home.
Right. Because it's got to factor in, right, to the value of it.
Yeah. And certainly then if somebody is buying that B-rated property, if as a broker I look at which mortgage options are open to them, it's quite likely that we'll find the mortgage they qualify for is classed as a green mortgage.
Right.
So one of the high street banks that would offer the most competitive mortgages in the market will offer a slightly more competitive product for an energy efficient home. So in that circumstance, a green mortgage would probably be the outcome for the consumer. But again, to rewind, there are 150 plus lenders and thousands of products.
Yeah.
The start point with all of this is to find the right solution, for the consumer, and that may be that it's a green mortgage, or it may not.
Or may not be.
So, like I said, to go back to this original point around green mortgages, they are a part of the jigsaw puzzle of green home finance and retrofit, which is a much, much broader topic.
I guess we're all becoming far more conscious of it in our day-to-day lives and how we purchase property now and how we live. So not a bad thing.
I do think at some point what we're going to see is mortgage lenders, and it's actually marked for this year. I don't think it's going to happen because of the economic turmoil, but mortgage lenders are going to have to publish a league table of all of their mortgage book. So how many properties have they lent on, have an A or B or C, EPC rating. So that league table is going to lead some consumers to make decisions, and people vote with their feet. Yeah. For a lot of certainly younger generations, but for a lot of people, they want to be aligned ethically with their financial services providers. And I think banks are slow on the uptake with this to a certain extent. And this is something that is growing in momentum, that for a lot of people, it's important for them to know that, like I say, they're aligned with their bank. The other sort of big side to this, like I say, is really just down to the cost of living. And how else do you tackle the cost of living other than try to reduce your energy bill?
Tackle it that way.
Yeah.
Later life lending, which you have now become a specialist in.
Yeah.
And I've had, just chit chat, mainly at the golf club.
Yeah.
And at the golf club, you'll have a whole variety of different age groups.
Yeah.
So I think the first part of this is applied to many, many people. But I was joking with one of my mates I was playing golf with, who's in his late 60s. And I said, I've got somebody coming on talking about later life lending. He said, well, what are you looking at me for? One chap in particularly on the first tee last week was like, so how does that work? I mean, could I take some equity out of a house that I own to buy a buy-to-let property, for example? So these are the sorts of questions that were being thrown at me. And I said, well, look, I don't know right now, but I'll hopefully know after Friday. Yeah. So later life lending, what does that look like? What does it entail?
Right. This part of the market has certainly expanded quite dramatically over the last few years. And by later life lending, what do we mean by later life lending? There are different types of solution. You have options to borrow via a conventional mortgage if you are in your later years. And by later life, I mean, I'm in my 50s, which is why I'm sort of in that zone, I guess. Now.
Really?
Yeah, I am. Yeah, I don't look at
one of the easier paper rounds.
Here's the £5. Well done, thank you. So technically, the later life lending market starts at 55. So for the over 55s, people into the 60s, 70s, 80s, and even 90s, this is what we're talking about when we say later life lending. So you have an option of a conventional mortgage. So this is, a very bog standard mortgage where a lender looks at your income and expenditure, conducts an affordability assessment, and provides you with a mortgage on a capital and interest basis or an interest-only basis. And that mortgage has a fixed term. So at the end of that term, the mortgage would need to be paid off either with a capital interest loan where the balance gradually comes down, or with an interest-only loan that's sold at the end of the term. So that was whether you have an investment or you sell the property and downsize, but it has a term.
Yeah.
That's key. Then we have retirement interest-only mortgages. Now, they've only been around for a couple of years.
So these are for people that are retired?
Not necessarily, but
Okay.
yes.
All right.
So, I mean, I'll kind of.
Okay.
So again, over 55. You've got to be over 55 to qualify. Lenders will conduct an affordability assessment of your retirement income. So they look at your pensions. If you're not drawing your pensions now, they look at your projected pension income.
I see, right.
They run an affordability assessment, and you are charged interest on how much you borrow, but it's the interest only. That's the only payment you're committed to make.
Right.
But there's no term. There's no set term. So a retirement interest-only mortgage, or RIO,
right,
as they call it, nothing to do with Brazil.
Okay.
They'll go on until either you pass away or go into long-term care. And for married couples, it would be the second of
right. Okay.
And then we have lifetime mortgages. So just like the RIO, there's no set term. So they go on until either death or long-term care. However, there's no affordability assessment.
Right.
The amount you can borrow is directly tied to the value of your property and your age.
Okay.
So the older you are, the more you can borrow. Now, with a lifetime mortgage, you can release funds pretty much for anything that you want.
Yeah.
So raising funds to use for cash to pay a deposit on a property would be fine. Gifting to family members would be fine. Buying a yacht.
So is this what we would call equity release?
So yeah, so the fourth option is home reversion. Home reversion. Now, that's where you give up ownership of your property in return for a lump sum.
Give up ownership of your property to
a provider.
Right.
You stay in your property, and the property ownership remains with that provider until you pass away, in which case then they have the property and they sell it. But they give you cash and you stay in your property. So home reversion represents a tiny part of the market. So a lifetime mortgage and home reversion plans are what we refer to as equity release.
Right.
It's jargony. It's in many ways an outdated term.
Because correct me if I'm wrong, equity release didn't have, in many circles, the greatest reputation.
It's fair to say that. I mean, there's a provider called Hodge who first lent via a lifetime mortgage in the 1960s.
Yeah.
So these types of products have been around for a long time.
Hodge is close to Dodge.
Dodge, not dodgy. Yeah. But Hodge actually provided these types of funds since the 1960s. In the 1990s, the Wild West of regulation, some would say, these products, I think the fact-finding process, the advice process was probably a bit too weak.
A bit like with lending in general.
Self-cert, yeah. So a lot of people, were just encouraged to take out loans without really understanding what they were getting themselves in for, if you like, weren't speaking with their family, and the products weren't very well regulated. In this day and age, it's very different. The rules and regulations are really strong. In actual fact, my boss, David Forsyth, used to work at the FCA, and he wrote some of those rules around later life lending. And it's important as advisors that we talk to consumers around their circumstances, their plans for the future, and their beneficiaries, and how they are understanding and accepting or not of what's going on. The Financial Ombudsman released some data a short while ago that showed, I think it's something close to 2/3 of complaints about later life lending comes posthumously from beneficiaries. So I didn't know Mum took this out. She must have been missold. So, potentially back in the 90s, a lot of people jumped into this, without having full facts.
Because you have those, like you say, the stories of beneficiaries coming back and saying, I didn't know mum, dad took this out.
That's right.
And is that what now is come in, regulations have come in to advise the beneficiaries as well as the person involved?
It certainly forms part of the conversation.
Right.
And we at Knight Frank are members of the Equity Release Council.
Okay.
The Equity Release Council sets standards for our market. And amongst those standards, you have, for example, a no negative equity guarantee. So your debt would never increase beyond the value of a property. So you'll never pass on debt in that respect to your children. All products, again, a lot of people have these sort of misunderstandings around the way lifetime mortgages work. They're set up on the basis that you don't have to make a monthly payment.
Right.
That debt, is charged every month and it compounds. Well, if you don't make a payment, of course, debt increases over a period of time. You are permitted to make payments on these plans. With most plans now allow you to make monthly payments.
Right.
So you can make payments on an ad hoc basis, but certainly you can stop the increase of debt if that's what you want to do. The market's a lot different. The regulations are there. They're strong. They're very consumer focused, and the market is in such a different place.
Because I think, are you seeing a lot of people, later life who own their property outright? Because let's face it, it almost combines with younger people struggling to get mortgages and deposits for mortgages. Would an option be for somebody who perhaps owns majority or all of their property to release some equity from that to provide to a son or daughter to get a deposit on a mortgage on a property?
Yes.
That's commonplace.
It's become a lot more common.
And does the son or daughter or whoever it might be, can you have it set up that they pay the interest?
So you've asked a few things there. I guess the first thing to say is that you don't need to own your property outright.
No.
So we have situations where somebody may have a mortgage on their property already.
Yeah.
It might be an interest-only mortgage. It's coming to the end of its term. They have no way to repay that loan. And at that same time, their children or grandchildren even are looking to get on the property ladder. They then, as homeowners, would seek to clear their current mortgage and raise some cash to provide financial gifts to their children or grandchildren. If the grandchildren or children want to then pay mum and dad or nan and granddad an amount to cover the interest, that's fine.
Okay.
So, one other thing, just touching on this, because you've mentioned, again, this idea of you have to own your property outright to release equity. A lifetime mortgage can be used for a purchase. Yeah. So for older borrowers looking to buy somewhere, they don't necessarily have to put all of their cash into a transaction. Where if they're, for example, seeking to downsize, they may take a lifetime mortgage so they can keep some cash back for themselves. But releasing equity, for gifts has become a lot more common. A few articles have been written about the varying things that people, borrow money for. Green home improvements has become a lot more common, particularly with older borrowers. They have a fixed income. Generally speaking, if you're retired, you have fixed income on your pension. With the energy price changes, you're now seeing your money is being eroded every single month by an increase in your bills. So the capital outlay makes sense. Yeah. If I spend the £10,000-20,000 now, my bills will come down. So home improvements that could also include new kitchen, new carpets, whatever, But borrowing for home improvements is quite common. But you can borrow for buy a caravan, buy a boat, to have funds to do things in the future. You don't have to borrow all the money up front. You can set up a facility.
Right, okay.
Bit like an overdraft, but not like an overdraft. Yeah. But you have a facility limit. So let's say you owned a property worth £500,000. You had a £30,000 mortgage at the moment. You wanted to gift some money to your grandson who's looking to buy a property, and you want to do things in the future. the solution that we would be looking to create would be a facility to release funds now to clear your current mortgage and provide that financial gift, but then the creation of a drawdown facility where you can access funds in the future quite easily. So there's not really an application process to access those future funds. So there's a lot of flexibility around later life lending now, lots of different options and lots of flexibility and good regulations.
So, and what you say, you pay just the interest on that?
You're charged the interest. Yeah, so with a lifetime mortgage, you're charged interest.
And what sort of rates are we looking at for that type of thing?
So interest rates on lifetime mortgages currently start at around 5.5%.
Okay.
And they go up to around 8% if you're going to the maximum loan to value. So for some people that makes sense.
So if I think
again, lots of products.
The question that was asked to me was that somebody owns a house that's worth about 700,000, I think, and he asked the question that could I release some money to buy a buy-to-let property from that? I mean, he doesn't have an income other than his pension, so that would be something he could do.
Yeah.
Okay.
Yeah, in simplicity.
Yeah. Okay.
Yeah, it's not much you can't
do.
Yeah, it's any legal purpose, I think, is the way.
And you say it's over 55.
Yeah.
In general.
Yeah, most of my clients tend to be in their 60s and 70s and 80s, but yeah, over 55 is where it starts. That's the start point.
Go and have a chat with Dad after this then. So in terms of what you're up to now, haven't you got some charity work that you're up to?
Yeah.
Did I see something to do with living on the streets?
Yes.
Right? So how does that work? What's that all about?
So next week, I am sleeping rough on the streets of London.
Right.
With quite a few of my work colleagues at Knight Frank.
Far to go, isn't it?
Part of a well, no, there's the sleep outs all around the UK.
Yeah, I think a friend of mine did one in Salisbury one year.
Yeah, they're all around the UK, and you can do it at home.
Yeah,
you can do it at home. But yeah, the idea is, I mean, it's run by a charity called Land Aid, who have now got their offices based at Knight Frank's head office in Baker Street. Right. So they were their tenancy came to an end where they were before, and Knight Frank graciously offers them some space at their office in Baker Street, so they sit very close to where I am. But yeah, they're organised to sleep out. I don't know the numbers, but there's quite a few people.
Okay. So where you'll be sleeping on the street?
Yes.
For a day, a night? One night.
Yeah. Okay. So we all meet, I think, between 7 and 8 p.m. On Thursday, I want to say the 3rd of March. I should know this.
That wasn't it. We'll put something up there.
Yeah. We're sleeping out. There's only hot drinks available, and the event finishes at between 5 and 7 the following morning.
Okay.
So I don't think I'm going to get much sleep.
No,
I've been told to be wary. Lots of background noise, and I've got earplugs. I've got I've got a eye mask. I've got a fantastic sleeping bag.
What's that raising? What charity is it raising money for?
So it's Land Aid.
Land Aid.
So they are raising money, awareness, really, and money for people that sleep rough in the UK. There are countless numbers of youths that are displaced and live on the streets, and they've all got terrible stories.
Good for you, mate. We'll make sure we put a link up to you've obviously got a link for people to donate to.
That's right.
I think I've managed to donate.
Yes.
I figured it out.
Yes, thank you. Really appreciate that.
No worries.
Any support is wonderful.
We'll put something up there for sure.
And I've got a bad back, so crikey, I'm really putting myself out here. No, but on a serious note, it's a wonderful cause.
Yeah.
And there's quite a few people taking part, so it is just about raising that awareness and
we see
just raising funds.
Even in this wonderful town of Bournemouth, the homeless situation here alone is seems to be on the increase. So awareness and raising money for that's got to be a good thing. Well, we're coming close to the end. We were going to say that we were going to talk about some news items, and I was going to bring the papers in, but the shop I went into didn't have it by the time we got it. But all I would say...
Well, you managed to find the croissants.
I found the croissants. The shop didn't sell the papers, but I think the croissants were probably going to be better than
we could talk about them.
Yeah, we could. No. But all I was going to say is two things. Today is the anniversary.
1 year anniversary of the invasion of
Russia
Ukraine.
invaded Ukraine. I mean, obviously that's also had, an effect on people's lives is the most important thing, but it's had an effect on for what we've been talking to today to some extent as well. So yeah, what do you make of that?
Well, my sentiment is with the Ukrainian people. Some of my colleagues at Knight Frank recently drove some supplies and vehicles down to the Ukraine. Handed them over. It's a terrible thing.
Do you know what really strikes a chord, I think, with most people? And they showed these photos earlier on in the conflict, but now people are sharing their photos, their last photos before the invasion took place, and it's just normal people living normal lives in their kitchens, with their friends, five-a-side football teams. Predominantly, most of those guys are probably fighting, and hopefully surviving at that.
That's the thing that really makes you stop and think. A year ago, these people, just like us, living normal everyday lives.
There was that picture of Christmas in Kiev, the centre this year, all black. The year before, with the wonderful trees that you see in London and Trafalgar Square and in city centres, it's unreal, and I think it feels so close to home, but. And the other news is still somber, but bless his heart, John Motson.
I know.
He's passed away. The football commentator. One of the lines, I heard it on Wave 105 this morning, was when Wimbledon were playing Liverpool. He said, "The crazy gang have beaten the Culture Club."
His voice to me will always be synonymous with football.
He said he was only 77, and that's not really that old now, is it? To be honest.
No.
And there was that one time he was reporting with obviously his big coat on that he used to wear in the middle of a blizzard, and he just carried on talking.
To me, it's like Murray Walker with F1. Those voices just become absolutely the defining voice for that sport, and it's terribly sad. My thoughts and good wishes to the family.
100%. Well, I don't think. We've covered an awful lot of ground, Matt.
Matt had a question.
What was your question,
Matt? I have a question. Should I get closer to the microphone?
Come closer to the microphone. We'll allow this. What is that question? Brace yourself.
Right, I'm bracing.
No, I think it's quite a good question.
He did ask the question you realised before about what is pork and where is pork from.
Right.
It's not
I'm getting a bit concerned about this question.
We worked out it's from a pork, didn't we?
Right.
I'm going to pretend I can't hear.
I'm nearer the microphone now. Right, so you owned your business, Cherry. What made you feel like you wanted to sell that company and then move to Knight Frank? Or I know it wasn't immediately after, but what made you want to go down that route instead?
That's a very good question.
Good question.
Very good question. Thank you, Hannah. I forgot to answer that. So Cherry was running for just about a decade. I think for a lot of people, the pandemic made you press pause and question what you do, which direction you're going in. And look, running a small business is tough. It takes up all of your time. It can be emotionally draining. It can be really rewarding. Certainly seeing something grow from nothing, from working on a laptop in my kitchen to seeing a business that had staff and had a presence. It makes you feel good. But equally, you are, the head of marketing, the head of compliance, the head of IT. You have to run your own accounts division, head of HR, head of sales. It's everything. And I've been working. You can ask my wife and my kids about this. That I work on holiday. So I would take my laptop with me. I would work hours every single day on holiday. And I just got to the point in that lockdown when we were all sort of forced to stop and take stock, just to step back a bit. You start thinking about what's important. I was fortunate then in who I spoke with, around the sort of sale of my business, and we came to a decent agreement. And beyond that, I just felt that I wanted to be part of a bigger team. And a firm such as Knight Frank and Knight Frank Finance have got a very, very good presence in the market.
It's a good name.
Very, very true. And I can say hand on heart that everyone I've met there has been of a particular caliber. So it was a good decision. Sometimes you make these decisions and after I think, crikey, what have I done? But I'm very pleased with my decision at that. And like I said, my motivation really came after the pandemic. And where I've ended up, I'm very happy.
I think we've all reevaluated what's important, haven't we? And work-life balance and everything like that. It's not a case of not working hard. You've got to get that balance right, haven't you? Good question, Matt.
Thanks.
I'm glad I didn't write that one down.
I know.
I feel bad about not writing that one down myself.
It could have gone either way.
Rather disrespectful to
I
me.
don't blame you for having reservations. It could have gone either way.
It could have gone. A question from you
could have asked
gone
the
either
colour
way.
of your socks. You know, that's what I think you were worried about.
Yeah, what are they? Oh my goodness! I knew you'd have.
There you go.
Yeah,
For anybody that's listening, they are Matthew Fleming-Duffy's got orange, blue, and red check socks.
And
Yellow.
Blue.
Is that?
And
Oh, yellow dots.
And three types of blue.
Yeah.
Happy socks.
Happy socks.
There's a plug.
Before we
Happy
finish,
socks.
oh, is that where they're from?
Yeah.
Oh,
I
excellent.
thoroughly recommend Happy Socks.
Before we finish, if so, I will put something at the end of this and in our description about how to get hold of you to discuss.
Yeah.
Property finance, later life lending, green mortgages, all of that sort of stuff. Is that the easiest thing to do?
Yeah, for sure.
An email address, perhaps, phone number, that kind of thing. And we'll put a link up to Knight Frank as well. And you've got, I think you said on your website earlier on, there's news articles sections that people can keep up to date with what's going on in the world of property and finance.
knightfrankfinance.co.uk. I think it's /news. If you want to really get some up to date and current and practical advice on what the mortgage market is doing, that's not geared so much at producing headlines. It's a valuable resource.
Really keep up to date, genuinely, without being manipulated by the mainstream.
You got it.
Matt, it's been an absolute pleasure.
Thanks for bringing me in.
Thank you for coming on, and
no worries.
Thanks again, mate.